Hello, 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 everyone. Good morning to you if you're in Europe, the UK. It's very early mornings if you are in the Americas. And if you're in Australia or in the Pacific, I know it's night for you. So thank you, everyone. I really am so grateful that you can make it to the event today. Over the course of 3 days, we've had 500 individuals dialing in from literally everywhere, about 60 countries of the world. So my unreserved, gratitude and thanks and just exceptional appreciation for you making time. I know you all are very busy. I can see your mommy from Texas. Thank you. Thank you. It's early morning, I know, for you, but you guys have made it here today. Without further ado, we've got a lot to cover. Just a lot to cover today. I'll do a recap in a bit, but I just wanted to put it out there how much I am really grateful for you guys supporting this and just making time to attend today. So I'll just pull up the slides on screen, and then we'll take it from there. So hopefully you can see my slides today. I know yesterday there was some complaints around the slides not being, not moving after some point. So please let me know via the comments. I can see the comments here. So please put your comments around whatever struggles you might be having if the slides don't show at some point. And I'll try also not to be too fast because there might be a lag from LinkedIn to whatever device you have. So let me know if you can see the slide. I can see that on my other device, which is also streaming. I hope you can also see the cover page there on the deck. So today is the final day, 3 days challenge. And what an amazing ride we've had so far. You know, the first day, you had myself and Anna Maria from Europe. You had that, you had launched into the deep, 6,000 feet into the deep ocean of the European Sustainability Reporting Standards. And you also had the opportunity to learn about the corporate sustainability reporting directives, right, which are mandated for EU member countries. And so if you are, in Europe, that's what applies to you. Also, if your organization is obviously going to implement the ISSB, that would also apply. Today, the agenda for today, please confirm if you can see the slides moving. Otherwise, I need to find a way to that. Please confirm if the slide is moving. Can anybody just help me with the comments there? If you can see the slides move. Okay, I can't see the comments. Okay, so the agenda for today will be doing a recap of what we've done so far in the last 2 days. And I also spend some time to just give you a sense of what will be our topic for today, IFRS S2. And then we'll go on to look at some next steps in terms of where do we go from here. Titi, thank you. Yes, you can see the slides. Fantastic. Thank you so much. Yes, I need to be sure the slides are moving. Yesterday we had challenges with that, so I appreciate you giving me that feedback. So yes, as I was saying, we'll look at the recap. We'll dive into IFRS S2. There's a lot in there, so I wouldn't waste time there, and I'll talk about next steps. So before I go into that, for those of you that are joining today, I know some of you are joining us for the first time. Quickly tell you a bit about myself. My name is Joseph Owolabi. I am your facilitator for today, but I've been with this group since 2 days now, just walking us through the various aspects of this challenge. And my experience being in Big Four accounting firms, where I've spent close to 2 decades now, just going through all the motions from risk advisory, to accounting, advisory, and what have you, and then finally moving into this climate space. So I've been in this climate space now for, I would say, about 14 years. And I've been everywhere. I've done a lot of training, like some of you are doing already. I've done the GRI training with Deloitte in San Francisco. I've been to Wharton for an executive education, as well as Harvard. So I've done all of these trainings. I'm doing my research, my doctoral research in this area. So it's something very close to my heart. I'm passionate about it. In fact, I set up an organization solely for this, and Rubicola. So I established 4 years ago just to help organizations with their sustainability journey, climate disclosures, and what have you. That's a lot about me for today. So we also had 2 other speakers that had joined us over the course of 2 days. We had Anna Maria, like I mentioned earlier, but it was also Louise. Louise is from IFC. And yesterday, I saw your comment. Yesterday was fabulous, right? So Louise brought in that lens from climate finance. So as finance people, we know we are the ones thinking about sources of capital, cost of capital. How does that make sense with the strategy of organizations? So, we're introduced to different instruments that are now available, from green bonds to climate funds, and what have you. And the sustainability-linked loans are now popular in the US and in Europe. So you find that you give out a loan, but you could have reduced interest cost if you as an organization meet some of, or that organization that invested in meet some of their KPIs. So if they meet some of their sustainability KPIs in terms of emissions reduction and what have you, then they can pay lower interest rate, and it can be very useful for them in that respect. So that's very, very interesting. And we also looked at IFRS S1 yesterday. So we looked at S1. S1 is focused on sustainability related disclosures, and we dive into that. There was a lot to think about, but at least you can start appreciating that standard so far. And so that's where we left it yesterday. But before I go on, again, if you're new, I just want to give you a flair of what we're doing here. So why are we here? Why did we organize the 3 days challenge? It's finally over today when we conclude this program. But the first thing is, there are 3 days where we just went into the standards. Not just the standards. We started with a good sense of background, knowing fully well that as accountants, we're not traditionally trained to think about, all of that non-financial reporting, environmental. It sounds too technical, and all of that. And so I started that, just giving you that background and starting it with things like what's ESG, what's sustainability, why does it matter, the social issues, linking that with world politics, some of the climate activism we've seen over the last 4 years, how COVID has played into that, and what led up to the formation of the ISSB by the IFRS Foundation. And like on the 26th of June last year, the ISSB released this first set of standards, 2 standards which are the core of this challenge, IFRS S1 and IFRS S2. Like I mentioned to you in the previous days, these standards are just the first of a stream of standards that will come along the way. So they've got their work cut out for them. And why it's important for you as an accountant? First, you want to be relevant in your organization, right? You want to be able to add value. So there'll be a significant change. We've not had this change in accounting in 50 years. So in 1973, the IASC, the International Accounting Standards Council, was formed, the precursor body of the IASB. And can you imagine 50 years ago, that was when several countries came together to form the IASC, and then they started thinking about one single set of globally acceptable standards for financial reporting, high quality standards. And then we've moved on over the years, decades later, 5 decades later. Now, IFRS has been reported in 140 jurisdictions around the world. So even in places like the US, where they're still using local GAAP, there's a convergence project. And you remember, for those of you that were part of the trilogy of standards, IFRS 9, 15, and 16, when we implemented that in about 2017, 2018, you saw how there was that convergence and working together, and how much work is required to implement new standards. So the same thing here. First, as accountants, we have to deal with the fact that This is new to us. It's not, balance sheet, asset liabilities, all of that. It's totally new stuff, right? We need to reconcile that with the fact that our organization is going to go through change, data requirement, governance, and we'll go into all of that. And so you need to ensure that you have the right skills. There's a lot of opportunities coming out in this area, climate fund specialists, assurance consultants, and what have you. When you are across this, it means that your employability index also moves higher. And that's why we're doing this. We're not going to stop today because there's a lot to cover. We'll move on to getting all of us in a community. And some of you have already requested to be part of that group. And I'll bring up the barcode shortly. I want to encourage you, if you're on this call or you get to see the video subsequently, please join the community. There are many advantages of being part of that community. You're going to have peer support. Just having other people going on this journey. If you're working within asset management or banking, and there's someone else working in another bank in some part of the world, and they are early adopters, you can share resources, you can share insights. So that peer support and interaction is one of the reasons you should join the community. There's also distribution of relevant guidelines. So there's guidance from the ISB. There's also guidance from across other players that are relevant and templates that we can share amongst us. I'll also be giving discounts. So there'll be trainings. I'll talk to you about some of the next steps later. But, my team, we're moving around the world for in-person training. So we'll be in Kigali, East Africa. That's the first place we're starting next week. And there's going to be a paid training there. So some of the opportunities you get is I'll be able to offer you some of these discounts. For those of you in that region, I'll be able to communicate that to you early. And you can come in there if you so choose and get that discount. So that's one of the benefits I'll put if you're part of that community. I'll also be providing weekly newsletters. From next week or so, I'm going to start releasing newsletters that are focused on these areas, just helping you, holding you by the hand, to understand the basic precepts of ESG, of sustainability, and evolving that to, more complex issues around ISSB and what it means for your organization. So it's a journey, and I want to come with you on that journey. Also, there'll be engagement. So we're going to bring people. You've seen how we brought Luis from IFC and Maria from Europe and all of that. We're going to bring sustainability heads from around the world in banking, in financial services, and extractive industry. I want to share their experience and how they started their journey, whatever number of years ago, and what that means now when they're trying to reconcile sustainability and financial information. Also partners from top firms, mid-tier firms, and across board. So please join this community. I'll put the barcode on screen, and I hope you can see that. A number of you have requested access already. Thank you to Chuku. You can see the slides. Fantastic. I'm grateful all of you can see the slides. It was a nightmare yesterday when I saw comments that some of you couldn't see the slides progress. So I'm checking it every now and then just to be sure. I'm looking at another phone. So if you see my eyes wandering around, it's just because I'm trying to check on my iPhone to be sure you're seeing exactly the same thing. Yeah, so the barcode is off screen now. So please scan this barcode. I'll leave it up there. So scan the barcode if you've not done so, and ensure that you at least can be part of that group. Again, these videos are always, if you go back on this link, you can replay the videos. There's a link. You can also type the bit.ly / climate disclosures #4, then accountants. That also will take you there. So whichever one works for you, either you scan the barcode with your mobile device, or you just type in bit.ly / climate disclosures #4 and accountants, all together, no space. That should take you to the group. Request to join, and the team, someone from my team would add you on later. It's a private group, so it's not public, right? So you need to be part of the group, and that's why I'm leaving this here. Hopefully you can see this now, but like I mentioned, you can always come back to it. There's a lot to cover. So without further ado, I know there are about 50 of us already on the call. Others will join. Some would play back when they have a chance. But again, thank you so much for joining. So today, like I said, we'll dive into IFRS S2. And so remember, just a brief recap from yesterday. S1 is focused on sustainability related financial disclosures. For many of you in the organizations you work in already, you would have, if you're a listed entity, a public interest entity, or an asset manager, and what have you, you will notice that someone within the organization is already dealing with this, right? So from just ensuring that you have the right disclosures, across risk and what have you, you will find that they've already captured this. Now it's up to finance to ensure that they are taking this information and making the good use of it. So how do you capture this information and ensure that it is well represented in your financial statement? That would be your role as a finance person. So like I mentioned, you're not going to start from scratch. You are not going to start from scratch. There's usually something that you have as an organization, and that's what you need to look in within the organization to ensure that that is captured. So when you talk about climate-related disclosures, it's totally different. Yes, you might have had sustainability-related disclosures, but you might not have some of the specifics of IFRS S2. And that's why we will go into this today and just discuss that together. So when we talk about S2, what would we be looking at? The emphasis is on investors. Remember, yesterday, when we talked about this, we said that unlike other codes, GRI, UN Global Compact, the SDGs, sustainability, the goals, sustainable development goals, the 17 ambitious goals that were set by the UN and all of that. When it comes to the ISSB standards, currently, it has an investor lens. Please note that. So it is very possible that what your organization is reporting in terms of sustainability is based on codes like GRI, which have the lens of double materiality. And we explained that a day or so ago, which means that they are not just looking at financial materiality. Remember, an item is material if its omission or misstatement or obscuring would impact the decision of users of the financial statement. Again, the focus here is on investors. So when we're looking at ISSB standards, there's a bias. In fact, the sole aim is to achieve financial materiality. Please note that. And what you need to know about the IFRS S2 is that it captures totally all the recommendations from TCFD. So I'll explain again. Many of you know TCFD already. You heard us talk about it previously, but if you're all joining for the first time today, TCFD was a body that existed prior to this time. It was a task force on climate-related financial disclosures. It was set up a while ago by G20, and other bodies along the way. It was chaired by Bloomberg's Mayor Bloomberg, the former mayor of New York City, right? And their mandate was for the first time to align all the divergent disclosure issues to come up with one global set of standards that entities around the world can apply with an investor lens. Remember, the focus is on investors. So TCFD did this work for a number of years, and then they came up with recommendations. And now they've completed their work. They no longer exist. But the work is now being carried over. The monitoring, we'll come to that. The monitoring of the standards will be carried over by the ISSB. So what the ISSB has done, because they're new to this whole area, right? And they can't quickly develop their own. So they're leveraging what has already been in place. And so for your purposes, you must know that for those of you that are in Europe, in the US, some parts of Africa, if you're working for listed entities, the banks and what have you, you'll find that you might have been having some disclosures to TCFD. I was talking to a colleague in Toronto the other day, and she mentioned that the group entity that our entity from Toronto reports into, I think in the US or what have you, they already have been disclosing TCFD. So you have something to start with. And so that's what you need to first establish. If you're on the call or you're on this platform, if your entity has been reporting based on TCFD, then you have something to start with. In fact, the ISSB retained that architecture. So some of the terms, in terms of the content of the report, is aligned to TCFD, which is fabulous, to ensure that we can reduce the pressure in terms of transition. The IFRS S2, it's important to know that it must be applied in accordance with IFRS S1. So you can't say, oh, I want to apply S2, but I don't want to think about S1. And there are a number of reasons why that is so. I'll touch on that in the next slide. But please note, these standards must be applied together, right? It's important. It's important, and it's mandatory. So you can't say, I just want to disclose climate-related issues. I don't want to disclose sustainability. No, you have to align them together. And I'll touch on reasons why in a bit. The SAS SP standards will provide guidance that you would need on industry-specific disclosures. Again, the ISSB is new to this. The IFRS Foundation just came new on the block. Sustainability reporting has been on for a long time. In fact, entities like GRI, Global Reporting Initiative, have been on this journey for about 30 years or so. So, this has been going on. They just came on the screen, and they want to leverage what's obtained. So, SASB, Sustainability Accounting Standards Board, is out of the US, majorly in the US, very well used there, vast there, and they have specific industry disclosures already. So what the ISSB has done is to leverage that, to say, let's use that for now, right? In the future, my expectation is that the ISSB will begin to, introduce its own industry-specific disclosure, but they are way off, it's going to take them time. Imagine IFRS, from the early 2000s when you had Europe, the EU adopting that, Canada, South Africa, some parts of Africa, South Asia, everybody coming on board. It took years. There are still countries, Vietnam, Middle East, countries in the Middle East that are still trying to get an IFRS. So it's going to be a long journey, right? So they're starting with they're leveraging what the SASB has done. Please also note, and I've emboldened that there, that apart from just this information being relevant for investors, you also need to ensure that information is material. And this is an area where you need to bring your finance lens to play. So when I talk to finance people, they're like, oh, I don't understand sustainability. No, you just need to know what you know as an accountant and leverage the way you learn, conceptual framework. The whole idea of elements of a financial statement, assets, liabilities, equity, revenue, costs, cash flows. Apply that thinking and other concepts such as, validity of data, completeness, all the assertions. Leverage it. That's how we think as accountants. Leverage it and use that when you think about non-financial information. So it's important to note that not only must the information be relevant for investors, it must also be material information. Only material information that relates to the risk and opportunities based on climate should be disclosed. This might differ from what you are doing as an organization already. Your colleagues in risk, your colleagues in investor comps, your colleagues across the organization that have been delegated, that have had this delegated to them by the board, might have only focused on, whatever risk, or sometimes people just use templates and you know how this works, right? Ideally, they should have thought about materiality. It's one of the concepts we walk clients through, even under ESG, before all the standards come. But it's not uncommon. It wouldn't be unlikely that for you to note that in your organization, they're just reporting everything. They're reporting on water, they're reporting on everything, paper, even if you don't have material issues there. You as an accountant should help the team think about materiality. And when we're considering materiality, there are areas where we should focus on. And it has to do with, things like, the transition risk, as well as physical risk. So when we say physical risk, those are things, damages that can happen from bushfires. We've seen all of that in places like, California, in Australia, where I live. We had our own fair share of that a while ago. So, when you talk about physical risk, it's the risk that damage could be done to assets, right? Either, leading to massive impairment loss on that asset, or, it could also lead to loss of lives and all of those things. So physical risk, you know that already. Transition risk. Transition risk is also very important. So when you think about climate risk, like I said, you're thinking about physical risk. I've talked about that. And also transition risk. Transition risk is the risk that your business model will be impacted by climate change. And so if you are a Total, you're a Shell, and you're thinking about what's the future for us, right? We've got all of this discounted cash flows into the future, 20 years, from which we derive our valuation, right? And if in the future, nobody's going to buy fossil fuel, crude, diesel, or whatever, and then what does that mean for us? and so you've seen all these entities, like I mentioned, in other sessions that they've started rethinking their strategy. And so those are transition risks, right? If you're a bank, your financial services, right? And you now say, I don't want to lend money to the extractive industries again, right? Because of the damage they do to the environment. I want to take mining off my books. What does that mean to your risk assets? So you've got all of this balance sheet items, right? Huge risk assets for you as a financial institution. And if the board is going to make a decision to say, we don't want to raise financial instruments to these players again, what does that mean to your business model? And so S2 requires that you consider all of that. Okay. And when you think about this material information, so I've talked about information as to the material. What are the specifics that you need to think about when you think about material information? What are the specifics you need to disclose? Number one, you need to think about the risk and opportunities. So it's not enough to just say, oh, climate change, we need to do this. If we don't do this, this is the risk on our business. You also need to look out for opportunities, right? The emergence of new industries around the world. So if the US has said by 2030, 50% of the motor vehicles on their road should be electronic vehicles, that's opportunities. Tesla cannot do that alone. Tesla can't fulfill its current demand. So there needs to be other players that would emerge to help drive this need. Yeah, if you're thinking about, potentially, if you're in crypto and you know that from Ethereum, Solana, and all of these crypto coins, they use too much. Bitcoin, they use too much in terms of energy. That means that we need to, discover or develop other crypto coins, alternate coins that will be more energy efficient. So that's new opportunities. So it means new players would come, or it gives an opportunity to some of these coins to go back into the strategy and think about how they meet that need. So it's not just risk. As accountants, I know we love risk. A number of us have been in risk roles over the years, internal audit and all of that. So I get it. But the requirement also is that we need to think about opportunities. And when you think about implementing these new standards, you can't do it alone, right? You need people from across the organization. But it is my view that accountants should lead. We should provide a direction. So you should bring people from your strategic team and challenge them to think about what opportunities will be there for us if we're a financial institution. And we have all of this financed emission, and I'll define financed emissions in a bit. So we've got all of this bucket portfolio of financed emissions. I want to get rid of them. How do we identify new opportunities? Because at the end of the day, the same investors want good return for their capital. We must not forget that, right? But it must not be in isolation or at the expense of the planet. So you must think about the risk and opportunities. You must think about your organization's response to those risks. What's your strategy for managing those risks? And what's your response to the opportunity? So there's a huge opportunity. You're a pump station, you're a fuel station, anywhere in the world, right? And that's what you've been for 30, 40 years. Now you want to build charging stations. You see that EVs are on the road and they need to charge, super fast charging. And you want to transition from being a pump station to, or you want to add that to your business over the years. How do you respond? What do you need to do? Are you going to do a capital raise? What kind of raise are you going to do? Are you going to set up a new vehicle? As a finance person, we need to help to drive this. Also, we need to understand what is the transition plan. So if we're going to do this in 5 years, if we're going to divest from this portfolio in 5 years, how do we get there? What impact will it have on our shareholders? And we need to communicate that to investors as we go along, right? Any questions so far? I know I'm touching on technical areas, so if you've got questions, please put it in the group. It's the final day, so don't be left out. Please don't be left out. Let me know if there's any way I can provide direction or insight to some of these things. The third thing you need to think about is how does the company adapt its planning, its operation, its business model to those risks? So the risk you've defined and the opportunities, how do you do an holistic, overall, how do you uplift your risk as an organization, your controls, your operations to meet the demands of the time? And more importantly, and this is very important, you also need to examine your value chain. So it's not enough for you to say, oh, we know what our architecture is. We are a group. We've got 3 subsidiaries. We've got like associates and joint ventures, but that's all. No, the standard requires that you look further across your value chain. And that's where supply chain becomes so important. I touched on assurance over the supply chain early on, I think on day 1. So this requires that you think about that. I told you earlier that it's important you implement IFRS S2 alongside S1. And why is that important? What are the reasons why the standard setters, the ISSB, have said that you cannot, take the IFRS S2 in isolation? You have to implement it alongside, IFRS S1. And these are the reasons. Number 1, when you think about S1 requires that you define what the reporting entity. So when you think about your normal IFRS, under IFRS, you need to determine what's the reporting entity, what period are you reporting, all those general information, all of that resides in S1. So all of those general information reside in S1. So if you don't implement S1, then there will be, you leave investors clueless about what you're reporting. So defining reporting entity, talking about defining what sustainability is part of what you do in S1. The concept of materiality, identifying what's your materiality and assessing materiality is also captured in S1. So that's one of the reasons. Also, when you think about changes in estimates, when you think about errors and disclosures around key judgments that you would make, talking about relevance and quality of information, faithful representation, and assertions that relate to ISSB, all of that are captured in IFRS S1. And that's why it's important that you implement IFRS S1 with S2. Other issues such as value chain, the concept, interactions with laws and regulations. So if there are specific laws here in the US, the EPA has the regulations there. If you're in Canada, now you've got the Canadian Sustainability Disclosure Standards, which was issued about 2 weeks ago. If you're in the UK, the UK is going to adopt the IFRS ISSB. If you're in China, already that 3 of the largest stock exchanges in China have released their own ESG disclosure requirements, and on and on and on. If you go on Singapore, Nigeria, you have a roadmap already. Mexico, Hong Kong, and other countries are coming up with either their own local standards, or they're choosing how they want to implement this. Right? The EU, like already, has been forward-looking when it comes to this. They have their own European sustainability reporting standard, and they've got the CSRD, all of which are effective 2025, but for periods in 2024. So they need to start reporting from this year. Also, connections with the financial statement. So how these new standards connect with the core financial statement and other information, corporate information, all of that is expressed in S1, as well as reliefs. So there are specific reliefs that you get. Sometimes practitioners, companies worry, and they say, oh, we can't do this because if we release some of this information you are asking us to disclose, then we'll lose our competitive edge. Our competitors would take advantage of that. They're sensitive, commercially sensitive information. There are specific relief for you as an organization. All of that is also from S1. So I hope it's clear to you now that the intention of the ISSB, for you to say you follow the ISSB Sustainability Disclosure Standards, you must apply both IFRS S1 and S2. I hope that is very clear. Quickly, thank you, Dolapo. I see your comments. Yes, S1 and S2 must be implemented together. Fantastic. Yes, Dolapo, spot on. Both standards must be implemented together. And now I go into the core contents in S2. So when you think about S2, again, remember, I told you what the standard setters have done is to start from somewhere, not start from scratch. They can't afford to start from scratch. This has been 30, 50, sometimes 100 years in the journey. There's been management disclosures in the US for many years. So they are just coming to the party. They can't just say, oh, they don't have all the time. So they're relying on the TCFD structure. So for many of you in financial services, you know the TCFD. For some of you in extractive industries, you know the TCFD. For some of you working with insurance firms, you started talking about TCFD a while ago. If you're not across the TCFD, no problem. But just know there was a TCFD called Task Force on Climate-Related Financial Disclosure. It no longer exists. It's been subsumed into the ISSB. And so the core elements follow that structure, that architecture. You got a governance aspect. You need to think about your governance arrangement. You need to think about the strategy, right? What are the strategies of our organization? How do we respond to some of these issues? You need to think about, risk management. How do you manage the risk that would come as a result of these climate issues, the impact on your business of the challenges of climate, as well as one of the other issues that may relate to metrics and targets. So it's important. This is where everyone's always run away from in the past. So with sustainability, you'll find that most people would not want to, think about targets, but it's now important. And I will come to why the ISSB have decided that it's important to think about metrics and targets. So again, when you think about your report, what it's going to look like at the end of 2024, when you're putting your financial statement together, for many of you that are listed entities, you're considering what we need to do when it comes to interim report, which is due in about 2 months, right? Thank you, Olayinka. Japan released proposed IFRS-based sustainability reporting standard 2 days ago. Fantastic. Thanks, Olayinka Popola. Again, those are things we'll be discussing in the community, and I need you to all, it's going to be very great. As a community, we'll share all of the insights from around the world, and we help each other learn, right? So thanks, Olayinka, for that. Japan now has their own proposed IFRS-backed sustainability reporting standard. So it's interesting. I need to jump online after this to see what that entails. Okay, so these are the core elements, and I hope that is well taken. Quickly, I know we have just about 20 minutes, but I'll go through this. If we don't finish, there will be opportunities in the group to have other live sessions. But I just wanted you to understand, because I know a number of you are new to this, and I don't want to rush it, right? So when you think about the important disclosures, so you know the core elements, but what are the important disclosures? When it comes to IFRS S2, what should be important for your investors, investor lens? What are the key elements that investors want to see when it comes to the standard? Okay, so when you think about strategy, and when you're considering your strategy and say, okay, what do we need to think about in the strategy? You need to talk about how you make your decision, the decision-making process as an organization. You need to think about your current, financial impacts. What are the impacts of climate on your business today? And you know that when we're thinking about financial impact, we're thinking about your financial position, right? Your balance sheet. What impact does it have on your asset? Are you facing impairment? Do you notice that you're a refinery, and because most people are going on solar, or the grid, it is divesting, from fossil or coal-related energy sources to solar, you notice that your revenue is dwindling, right? And then there's possibility that there's impairment on your assets. You need to think about the effects now. The effects on your financial position, effects on your performance, how much of your revenue, how much of your costs has increased. Now, in some regions, there's carbon tax, right? How much of that is bringing, increased cost of production for you? And the anticipated financial effects, not just the current effects. As you look into the future, it's on us as CFOs, as finance professionals, as risk analysts, whatever you are on the call, to think about what will be the anticipated financial effects. So if in the future, all of this, by 2050, whatever the timelines your countries have agreed to at COP, any of those COP events, what's it going to mean for your business? And you need to communicate this first to your board and to investors. So when you think about strategy, those are the things you need to think about. Last but not the least, you need to communicate your climate resilience. So it's not enough for you to say, oh, we've got a strategy around it, we've got a transition plan, all of that, we know what impact will be. How are you resilient? Investors are concerned. So if some element of your assets, huge assets, rigs, billions of dollars, right? Think about all of these IOCs, international oil companies, right? They've got massive assets. Employees working on those things. If you're going to lay them off, there's probably, we know that from our financial reporting, right? That IS 19, right? There'll potentially be all of those restructuring costs that you need to think about. So when you communicate climate resilience, these are part of the things you need to think about. What are the scenarios? And it's very important. The standard setters requires that you think about scenarios when you come to this. The next thing when it comes to important disclosures is that you consider metrics and targets. So there are environmental impacts that you should think about when you're thinking about metrics and targets, but not just restricted to GHG, right? And that's greenhouse gases. So greenhouse gas is popular. One of them is carbon monoxide, but there are 6 or so of those gases. Those of you that are, biochemists and chemists in the room, you know all of that. But I won't bore the accountants with that details. Just know that there's what we call greenhouse gases, right? It's harmful to the environment. It destroys the ozone layer. It leads to things like cancer. It's what's eating up the environment, right? So you have all of these high temperatures when it's summer in Europe, in Australia. We get so many, so high degree in terms of temperature, right? And sometimes when you're in winter, it's still hot, right? That's what's causing all of that. And so globally, there's that intent to try and reduce greenhouse gas emissions. So you need to communicate that, right? You need to think about industry-based disclosures. I talked about that earlier. And again, there's the SASB standards for you to reference there, as well as climate-specific targets. So we'll go into this quickly. We've got about 17 minutes. Please, if you have questions, keep your questions coming. I'll try to keep to time so that, we don't, delay some of you that are just about starting work, or if you need to go to sleep. I know it's night already in Australia or New Zealand, and late evening in Singapore, China, and all of those places. So please start dropping the questions. I'll attend to them as we go. Don't wait any further for that. First, when I talk about strategy, right, the intent is that you need to think about the effect of climate-related risk and opportunities on your strategy. As you think, how do you make decisions? So this is critical for the board. You need to take your board along on this journey. What I find is that most boards, they're clueless in what's going to happen, right? I'm a member of the Australian Institute of Company Directors, and they're also trying to take all of their members on that journey. So it's important that you get the board, those that have oversight over the organization across all of this. How are you going to respond? What's your plan? How have you responded so far? If you're an insurance company and you notice that there's just a lot of, claims coming in from assets along the coast, some of these very beautiful houses, the premiums are not even well calculated. You didn't think about climate change when you were, computing actual valuations. And now then there's all of this risk, right? If you're in places, along coastal countries, Caribbeans, in Asia Pacific area, Solomon Islands, all of these places, and all of this is happening as an insurance firm. It changes the game for you. So how have you planned to respond to this? What's your transition plan? There's no specific requirements on coming up with a transition plan, but it's important for you, those of you in the UK, that the UK Transition Task Force does require that you come up with a transition plan. So if you're in the UK, please note that difference. For those of you on the call from the United Kingdom, the Transition Task Force in the UK does require that you have a transition plan, right? Also, you need to think about resourcing. What's your current, where are you currently in terms of resourcing? The people you need, upskilling them, having the right skill sets and all of that. And what's your future plans? When you're thinking about resourcing, what's the future plan for resourcing? How are you tracking against previous plan? So if you set previous agenda, how are you tracking against this? Which of the disclosures do you think organizations are finding most difficult, right? I think that's what that is. Yeah, so which of is most difficult and challenging? We'll get there very, very soon. Thank you. I got that question, and we'll get there soon. Difficult ones, I'll touch on it soon. So the next thing you need to think about is the current and anticipated financial effects. So what are the effects of climate-related risk and opportunities? So CRRO, there is my acronym for climate-related risk and opportunities. So like I mentioned, think about immediate effects currently on your financial position, which is, statement of your financial position, your financial performance, as well as your cash flows, but also anticipated future effects. The standard setters prefer you have a quantitative disclosures, right? Quantitative. They want you to quantify that. So the preference is for quantitative. However, both quantitative and qualitative information are acceptable. So you need to provide all of those anticipated financial effects and current financial effects. Preferably, if you have a number, you can use. Sometimes, if you don't have a specific number, you can use a range. But I mentioned that there are instances where the qualitative disclosure would be allowed. And some of those are put up there on the screen. So there are instances where you'll be able to use, qualitative disclosures, and it includes where you have a high level of measurement uncertainty. So if you're saying that, yes, we know we'll be impacted by this, but we don't know, we cannot tell, we cannot give you, we can't tell precisely how this is going to impact because there's so much uncertainty. And when we think about financial reporting, when it comes to, when the assumptions, when there's all of that, you also need to disclose that. So when you say that, oh, we can't tell, it's just there's volatility in this case, then you can use a qualitative disclosure. When you cannot separately identify what is qualitative or what is quantitative, or where there are other elements there, there are other elements that will not give you that, you can choose to go for qualitative. Also, where you have anticipated effects that will not be commensurate. So if you're a smaller organization, you don't have the team, you don't have the resources, or you think you will not be heavily impacted by this, you can give that also as a reason why you're saying, you know what, at this stage, we'll just stick with qualitative. So remember, quantitative preferable, but you can use qualitative. Dolapo has asked the question, what's your view on how industries can be seen as primary stimulators of climate change approach? S1 and S2. Oil and gas meets industry. Is there an implied existential threat for those industries? You're spot on, Dolapo. There is an existential threat for those organizations. If you're in the oil and gas, right? I mentioned over the last 2 days that I know Total, way back. Well, about 14 years ago, I know because I worked with them in Africa. I knew they were thinking about their strategy. They were thinking about just divesting from crude to gas because, there's transitioning. The world now accepts that, yes, we want to do away with fossil fuel, but the energy need is huge. And so gas is still more cleaner. And so they're still focused on gas, right? And so Total over the years have tried to rethink their strategy and position along those lines. So that's why it's important for us as finance people to help our organizations think about this. I know in Africa, in Nigeria, where I'm from, one of the most the wealthiest Black person or African just built a refinery. And yes, there's still need for that, right? Because, you need to think about the trade-offs. You need to think about sustainable development, right? But, probably for another 10, 15, 20 years, but that down the line, you need to help the organization rethink that strategy. And I hope that answers your question, Dolapo. So in terms of anticipated financial effect, there are also things to consider. You should think about all reasonable and supportable information. So it's about what you can vet, what you're sure, what you have confidence in reporting without undue cost. So the intention of the standard setter is not to make sure that you go spend too much money. What can you readily achieve with what you have within, the effort you can put in? The approach deployed must also be commensurate with your available skills, capability, and resource. If you're a financial institution, you've got all of the resources. You need to go in depth. If you're a small organization, your impact is not so big, your supply chain is not so big, then you can also communicate that. And I hope that helps. Okay, number 3 there is climate resilience. So it is important that you think about climate resilience for your organization because we know that climate change and its effects and uncertainties also coming as a result of climate change would affect your organization's business model. We know that already. So even though there are no specific scenario provided, relevant scenarios can be used. So wherever you see a relevant scenario that you want to use to communicate that applies to your industry organization, you can use that in providing that risk assessment. So your climate resilience assessment must be done. The inputs and the key assumptions used in that scenario analysis must also be communicated. You need to communicate what are the inputs, what are the assumptions you've used in doing that. So when you think about this, these are some of the things you will not find in your sustainability report. These are some of the difficult things you need to think about according to Adedotun. These are the challenging areas, climate resilience. We are the specialists when it comes to scenario analysis, right? It's finance. We are the ones that come up with all of these models, right? We need to start designing models, climate resilient scenarios that we've thought about. If this happens, if there is if the evolution of EVs it's fast track. If there's a policy by the government to say that all vehicles, like they've done in the US, all vehicles on roads in Bangladesh or in Mumbai should be EV by 2050. It changes the game. What does it mean for Toyota? What does it mean for all of these guys? And all of them have started developing EVs. You know that already. But what does it mean in terms of supply chain? How do we also meet the demand? Those are things you need to think about, and you need to have those scenarios well planned out. Again, the emphasis is on all reasonable and supportable information, but you don't need to break your back. That would not involve undue cost or effort. So please, that's the guidance from the standard setters. And you, as custodians of financial reporting, as financial controllers, as CFOs, as finance person, senior manager, whatever you are, you should bring that lens to conversation. Otherwise, the risk people, your sustainability expert, they just want to go all the way and it will get so technical. But you need to think about it from cost benefit and all of those things that you know well enough already. Right? So when you're thinking about what, I talked about commensurate approach. And your next question, some of you might want to ask is, when you say commensurate approach, what do you mean? What do you mean? Here, the standard setters have reverted to the TCFD. So as part of recommendations from TCFD, the TCFD have stages of progression for organization. So if you're a beginner, right, if you're a new entity and you're a beginner, then there's an approach when it comes to scenario analysis that is applicable to you. If you're an intermediate player, there is an approach. If you're an advanced player, you're in financial services, you've been reporting TCFD, you have 5-6 years experience under your belt, then there's an approach that would work for you. So there's a guidance on this. There's an ISSB guidance. We'll communicate. I'll share all of this with you. Please join the community. I'll provide all of this in the coming weeks, and we can have conversations on that. We'll bring people on the live, experts on the live to talk about this. But this is guidance that has been provided to help you determine what's commensurate approach. How do I determine what's commensurate? And I hope that helps, because I know some of you would come up with that question in terms of, okay, Joseph, what do you mean by commensurate? How do I determine that? What are the bases? In terms of thinking about that already. Thank you. I see we've got 75 people on the platform. Thank you for making time to be here, and thank you for your contributions. So see, when you think about this, right, the idea is that, the standard says I want to help you in coming up with what is holistic. It must be robust. So it's not enough, in the past, sustainability reports is just wishy-washy here and there. It must be robust. It must be a rigorous assessment. But the expectation is that you progress over time. You won't get there in a day. It will take you a few years. It's a journey, right? And so that's the thinking when it comes to standard setters. So I'll move quickly to the number 4. We've got 6 issues to look at in terms of key disclosures. The number 4 issue still, we'll look at things around scope 1, scope 2, and scope 3. This might be new to many of you if you're not in the sustainability area, but I'll explain quickly. So for the benefit of that, I'll just touch on this quickly. So when you hear scope 1, they use that very often, and I'll come to the questions. There are a few questions there, but I just want to explain this first. What is scope 1? Scope 1 are your direct emissions. So if you've got a factory, you're an FMCG, right? Fast-moving consumer goods, Unilever, all of those guys, Nestle. You've got a factory where you produce all of the chocolates and beverage and all of that. That plant, is running on whatever diesel. Direct emissions, that's scope 1. I hope that's clear. Direct from your operations, direct emissions, scope 1. When you talk about scope 2 is your indirect emissions. So you're a professional services firm, big 4, mid-tier, whatever. And in your offices, the lights everywhere, beaming, all of that, right? The light, you did not produce the light yourself, right? It's from the grid. And so the grid would have produced the electricity in one way or the other. If it comes from coal or fossil fuel, that is your scope 2. Even though it's not your direct emissions, but you're using it for you to have light, right? The energy is coming from a source. That's scope 2. So your purchased energy, emissions from purchased energy that you consume as an organization is what we call scope 2. Scope 3 is any other thing that is not in scope 1 or scope 2. And that's all other indirect emissions that occur in your supply chain. Scope 3 has been very difficult. Someone asked the question earlier, I think it's Adedotu, that what's the difficult area? Scope 3 has been the thorn in the flesh for everybody in the sustainability area for many years. When I work with clients, big banks, smaller entities, and we're thinking about Scope 3, when you're trying to do the either advisory or even the audit, the assurance engagement, and we're trying to, vet what they've put, the numbers there, it's challenging because, there are different protocols to it. But I'll tell you what the standard setters have decided to do, right? And why is this important? You say, okay, why complicate this? Why is this important? Why do you need to think about scope 1, 2, 3 GHG emissions? Why are the standard setter demanded that this is important? I'll run through some of the reasons quickly. Number one is because there's changes in consumer preferences. We know that there are transition risks associated with these emissions. So if we want to curb global emissions, we need to start setting targets directly. Go for the elephants in the room. We know it's GHG emissions, and that's the reasons. Investors need this information. If your immediate organization, the group structure, parents, subsidiaries, all of that, but more importantly, your supply chain, other guys that you're not looking at. If you're a bank, you're like, oh, we don't emit, but you've got financial instruments that are raised to all of the IOCs. You have financed emissions. So we need to start thinking about what impact, as an investor, we're thinking, this industry, this company, how it's going to be impacted by climate change. And the main thing, the main indicator to help is GHG. And that's why that attention is on that. However, there are transition reliefs. So ideally, you're supposed to use the GHG protocol corporate standard, right, to measure your GHG emissions. That's the standard you're supposed to use. But to help with these transition reliefs, remember your IFRSs. When you transition to IFRS, the standard setters, in that case, the IASB would give you transition relief. Here, there's also transition reliefs, right? Transition relief here is that you don't necessarily need to use the GHG protocol corporate standards if the jurisdiction where you are, if the EU or Nigerian government, Australian government, Canadian government, or the parliament in Barbados says that, oh, for this country, we want you to use a different standard. So that's one. The next thing is where you currently are using a different method that you've been using already. The standard setters have given you 1 year. So your first year of moving to IFRS S1 and S2, you can continue using whatever protocol you are using for your GHG emission. That's why you need to now talk to each other. So this is an enterprise-wide implementation. So you need to talk to your sustainability risk persons and understand what they're doing, your technical facility people, your engineers, to see what protocol they are using already, because you might be able to claim a transition relief. I hope that is spot on. However, you must still disclose how and why every specific inputs and assumptions you've used and the estimates you've applied to measure your GHG gas, the emissions, how you've come across those specific inputs. And if there are changes to this over the years, you need to also mention that. So it's important that you disclose that and also measure that. I know we're running out of time. I'll quickly just, I'll leave it there for emissions. There's a lot to think about when it comes to emissions. There are different categories for emissions that you need to think about. But the emphasis, please, finance people, help your organization when it comes to this case. The emphasis is on material risk. So I put up the categories on screen. I won't bore you with that, but it's anything within your value chain, investments, business travel. If you get on first class, business class, economy, all of that is scope 3. You need to think about that. There are 15 categories in that protocol I talked about that you need to consider if they are material. Emphasis on if they are material. For those of you in financial services, there is this financed emission. That's a big one. If you're running away from it for a long time, banking, if you're in banking, if you're an insurance company, if you're an asset manager, BlackRock, all of you guys in the room, this is the big one. This is the big one. You can't run anywhere this time. It's massive. Your risk assets, all of those huge risk assets as a bank that you have in your balance sheet, you need to think about them. So it's not enough to say, oh, we're a bank, we're not a upstream player, but you finance them. So financed emissions is anything, any emissions that is associated with your investments, your loan notes, any form of financing that you hold on your balance sheet. And so asset managers, all of that, they are impacted here. So what are the supports that is available? I've mentioned to you that you need to think about all of this in the concept of what is reasonable. Please, what is reasonable? What is supportable information without undue cost or effort? That is important. There's exemptions, right? For year one, I've run you through that already. There's also permission to include information from companies in your value chain. You might not have this information, right? Whatever the guys in your value chain has given you, you can use that for year one. There's a guidance on this we share in the group. When you're thinking about what to disclose, the standard setters expect you to disclose, direct, readings. Sometimes you can use estimation if you don't have that. They want primary data. Where you cannot get that, they've also said you can use secondary data. They need more granular. They need you to break that down by business, by division, by revenue lines, all of that. If you cannot do that, you can leave it at less granular. The expectation is that this information will be verified. Some level of assurance, audit, you might want to call it positive assurance, negative assurance, whatever you call it, as you know already from our financial reporting. However, even if it's not verified or you cannot do that in the first few years, the standard setters would still be able to accept whatever you have, as the disclosure requirement. So please think about this in that continuum. I want to just take last few questions. We won't be able to cover some of the other things, but they are just industry-specific disclosures. I've talked about that earlier, so don't worry so much about that. There's not a lot in there, but there's a SASB disclosure for you to think about. So we won't touch on that today. There's also targets. So no emission target is been required by the standard. The standard is not saying you should set any target, which is good. So that's interesting to note. However, where you have specific targets, you need to disclose them. Where there's a requirement for a target by laws in your country or regulations, you need to disclose that. So that's the only thing there. But you don't need greenhouse gas emission targets. Please note that. That is not required. So I'll just stop here. But seriously, I just want to thank all of you for joining. And a lot of you have asked me, what are the next steps? But before I come to that, there are a few questions that I want to quickly touch on. And so someone said, I've attended some ESG focus session, blah, blah, blah. How can products be competitive with the status quo, especially from perspective of supply chain? So yeah, green financing is challenging because you need to verify that you meet the requirements. There's greenwashing. That's a big one. We talked about greenwashing yesterday. The first lawsuit, against the company for greenwashing was done in Australia some few months ago, and the company has to pay. So now there will be reputational issues, coming out of greenwashing. You can't just be putting things in your financial statement that are not verifiable. And so as finance people, we should also put that in mind, right? So that's why green finance is still challenging so far. Dolapo, you've asked the question, what's the cost of compliance? Do you see cost-benefit analysis challenge for small businesses? See, I think it'll be left to regulators. I know you're in Nigeria. The FRCN has come up with this roadmap. Canada, been thinking about. In Australia, we had exposure draft. We responded to that some months back. We expect the standards, the Australian sustainability reporting standards, to be issued here by June. And the Parliament has said that it's going to start implementation. They're going to delay it for 6 months. So we'll start implementing in January. So each country will come up with how they want to do this, right? So it's up to the regulators. You know how the ISSB is, right? You know how the IFRS Foundation is. For financial reporting, they leave it to the country, to do all of that. Same thing with the ISSB, which is also under the IFRS Foundation, right? The challenge is that, the first attention will be on listed entities. You know that already. So if you're a listed entity, they're going to come for you. If you're a public interest entity, your bank, insurance, mortgage, all of that, they'll come for you. If you have a lot of stakeholders, if you are extractive industry, because of your impact on the environment, you can't run away from this. So whichever way you look at it, and for you in Nigeria, I know there's a roadmap. I know that the FRCN is socializing that with stakeholders. This is an opportunity for you to make an input to the FRCN and give them positive guidance on some of the challenges you would have in emerging markets to implement this, right? So I hope that answers your question. Of course, there will be cost, but remember, you should avoid undue cost and effort, right? It's about what's reasonable and what's supportable. Please, that's the important thing there. So to wrap this up, I put up the slide again, guys. Please just try and make sure you join the community. In terms of next step, right? We're going to have we're going to launch a masterclass. This is a lot, right? We can't even run through it here, but I just wanted to give you an idea, because many of you, I think there are many reasons why this should be important to you. Number one, it's about yourself. Building that career, ensuring that as changes come, artificial intelligence, right? Sustainability is here and everything is changing. You're not left behind, right? The future of accounting is changing crazily, right? You need to ensure that you flow with the wind of change, and that's why you need to equip yourself. Then again, to be relevant in your organization, this is where you can, the increased relevance you can bring by having this understanding. So see, we're going to come up with a masterclass. Sometimes it's going to start sometimes in May. So please join the group. We can carry you along. Up front, I can tell you it's going to be intensive. It's about 8 weeks, 2 months. The intention is that for those of you that have interim reporting requirements, or you want to start trialing this out before you report, at least do an internal report, share with your management. They can see some of this impact. Then this is for you. It's not for everybody. For those people, for those of you that are also thinking about year end, I want to ensure that you're ready. Or you're thinking about changing jobs and you want to bring that skill. You want to apply for roles that are focused on, financial reporting, sustainability, or climate risk specialist. Those kind of roles are now out there. You need to check them out. This will be for you. Intensive. 8 weeks, 2 months. Upfront, I can tell you, for being part of the community, I'll offer a 25% discount when that time comes. But, we're coming up with the details. We don't have it already. Please join the community. Scan the barcode. Join the community, request to join. I'll see you there. But thank you so much for your time. Like I said, there are many opportunities, even free opportunities on the community. It's not about being part of a masterclass if you don't want to. Every fortnight, we would have, experts coming into the room. We'll be on live on LinkedIn, just talking about this issue, giving you these things for free, right? If you're in the community, we would have a newsletter. I'll send that to you. Over 500 people register for this, and we will send you the newsletters every week on these things to help you with your skill set. If they are paid in sessions, right, face-to-face training in all parts of the world. We're doing one in East Africa next week. There's plans already. I have a call after this to go to Europe. So we'll be in places like Cyprus and Greece. And so working with different partners to bring this training to you, closer to you. And so for those of you in the community, you will get discounts, right? So that's one of the advantages of being in the community. But thank you so much for your time. I know you need to go. It's good evening from me here in Australia. Thank you for coming with me on this three-day journey. The video will be on the link. You can go back if you need to just revisit some of this. If there are questions, join the community. Some of the colleagues would answer those questions. A number of you are experts in risk, in sustainability. I would also be there, every other day to chat and all of that. Let's keep this going. Thank you so much. Good morning to you if you're in Europe and Africa. Good evening in the Pacific. And thank you so much for coming with me on this journey over this last 3 days. Thank you and take care. Bye-bye.